All right. Hey, good morning, everyone. Welcome, and thank you for taking the time to join here this morning. I went ahead and hit the mute button for all. I know most people are harvesting, so they can't join live, but they will be listening to the recording later. So I put the mute button on to keep the background noise to a minimum. All right, I'm going to jump right on in here today. There's not a whole lot of new information that we need to go over and talk about from the last couple of weeks. We're just kind of in that time period where the market's waiting on more information. As the harvest comes in, as the crop comes in, everyone's just kind of on pins and needles to wait for the next adjustment or to see where we are. And from a demand standpoint, there's just not a whole lot of new information that's out there to talk about. So let's go through the major pieces. The first one is, why are we so strong from a basis standpoint in the corn market? Well, that's because the drought and the crop size in the West, which is here, is a disaster. And I think most of you live in this area. You know that it's not nearly what it has been over the last couple of years. So just what does that mean? Well, talking to several traders, what that means is that we're roughly 1,000 trains short of corn in the panhandles of Texas and in western Kansas. So we have to bring in 1,000 unit trains. That's 1,110 car trains from the eastern corn belt into this area. So that's why our basis is just screaming hot, because you have to be able to pull those bushels from the river. And one of the issues that we're running into is that even though our exports are slow and lacking, it still pays for the river exporters and the river terminals to hold their bushels and not let loose of them and send them west. So that's keeping our basis extremely firm, and that's also keeping the spreads from inverting. So if you look at the corn spreads, right, this morning, the Dece to March spread is trading at is 5 cents under. Dece to May is about 5 cents, and then Dece to July is trading at even. Okay, option. So we're close to inverting December to July, and from my understanding is that if we're really that short and we have to pull the bushels away, then you have to destroy the economic incentive for the river exporters and the river terminals to sit on and hold grain for exports. And the way the market does that is first through basis and then second through spreads. So if the market decides that it really has to have those bushels out here, then it's going to extract pain on the commercials by inverting. And when it does that, that's going to push bushels back our direction, and we're going to see a nearby futures rally because we've got to pull the bushels in. And my understanding, and again, this is almost unprecedented in our corn market to have that big of a deficit out west. So the market's really trying to digest some pretty heavy information here. And even the guys that I'm talking to that have been doing this for 30 and 40 years are unsure exactly when this is going to happen, and so or if it actually has to happen. The market's just kind of sitting there toiling. So because of the unprecedented situation, what have we seen happen in the corn market? I'm going to put the volume graph on here, and what you see is the volume trading as low as it's been trading for a long time. It's not unusual for the nearby corn contract to trade 400,000 or 500,000 bushels or 500,000 contracts a day. 800,000 contracts isn't unusual. But in the last 6 months, we've barely, it's hard for us to break 250,000. So the liquidity in the market is just dried up completely. And it's not because people aren't interested in trading it. It's because the market is so conflicted in being pulled by global recessionary fears, pulled by an unprecedented basis situation, and really strong domestic crush margins. The corn margin for an ethanol plant right now is $2.50 a bushel. So if you buy a bushel of corn, turn it into ethanol, you are going to net $2.50 a bushel on it. So these processors have every incentive in the world to gobble up as many bushels as they can. But yet we cannot break and we cannot push this futures market higher. So what does this mean technically for us, right? Oh, and then the third piece is, the whole Putin corridor, World War III kind of thing going on that the market doesn't know what to do with at all. And none of us have any insight there. So I'm not even going to try to talk about it other than to say if the Ukraine and Russia aren't going to export corn, that's an awful lot of bushels that we have to supply. So to me and my limited understanding there, that's got to be bullish because where else are we going to go grow the bushels, right? So what does this really mean technically? Okay, we have been consolidating in this 680 range since late August. We have really not been able to move the needle at all. And every time it breaks, it just gets sold. And every time it dips, it just gets bought, right? So who's selling it? Well, obviously it's you, it's the farmer, and it's also the speculator because they're trying to exit. So market rallies, they exit stage left, say thank you. I'll take my ball, go home, and wait for a little bit before I re-enter. It dips. The end user says thank you. I need to buy cheaper corn, but I don't want to hold the risk any higher. Now, technically, we have just gotten into a really, really tight band, and I think this is making people very, very complacent, thinking, oh, it can't go down, or oh my gosh, we're just going to be range bound for a while. I completely disagree with that. I think that the next move is going to be staggeringly big. I think that there's so much tension and so much power and energy coiled up into this trading range right here. I think that the next move is going to be measured in dollars, not cents. And the risk is down for you because you have the bushels, you want it to go up. I know you do. I want it to go up too because I love it when these things are green. But the reality is that we have export numbers that are down 13% from a year ago and almost 22% from 2020, 2021. So our export numbers are getting crushed. Now, can they come back? Sure, they can. China can come in and start buying 10 million metric tons a day, right? They did that in 2020. I think they bought 18 straight days, and some of them were 5 million, 10 million. I mean, they just bought billions of bushels. But the numbers are, in exports in 2021, we exported 2.7 billion bushels, and this year the USDA has us at 2.1 billion so far, but that number is getting increasingly slowed down based on the absence of China in the market. So I promise you, and let's make this super simple. If we don't export 2.1 billion bushels, let's say that number drops to 1.9 or 1.8, that is just simply adding straight on to our carryout because we only have so much processing capacity. We only have so much livestock to feed, and everything else has to be exported or we just stockpile it. So if those exports do not materialize and we fail to hit that number, then our carryout is going to swell to 1.6, 1.7, and this market will drop. How far will it drop? Well, it's going to come all the way back down to 560 for starters, and it's probably coming lower. So the downside risk is very, very real in this market. Now, what's so hard is that so is the upside opportunity. Because if they do come in and start buying, right? And let's face it, China didn't grow a monster crop. It's not like they imported it all from the Ukraine. The Brazilian crop was light, and so they didn't really import it from there. So where did the corn come from, right? They either didn't buy it, or they have decreasing usage, or they're just not telling us everything. So the reality is, the world has not oversupplied itself with corn yet. It's going to, but it hasn't. And so at some point, end users have to come in, and countries have to come in and buy and secure their food. So if they do that and they decide, oh my gosh, we have to move higher, see this 3 right here? That implies an explosive move higher which would challenge these old highs and take us out. So that's why I think that the market is coiled. The next move is going to be extremely large, and it's going to surprise us. But because of where we are, I don't know if this big long sideways move is consolidation after this big move down, or if this is all consolidation after this move up. I don't think there's any way to distinguish between it. And so you're caught between, is this a rally in a bear market, or is this a sideways move in a new uptrend? And that's why traders have gone home and closed their position and moved out, because they're waiting on the market to reveal itself and reveal which way it wants to go before they pile back on. And so the absence of their trading is fodder for the propulsion that we're going to see on the next move out. So that's why I want us to be hedged. I've been saying this for weeks. When we do break this thing, if it does, I don't think we're going to be able to jump on it. It's going to look like that. It's going to be an elevator shaft, and I think it's going to be. I think it's something that we need to be in early, and not holding the ball and try to get on it later. If we break higher, fantastic. We'll happily fall on that sword and buy it and re-own it, and we'll enjoy the ride all the way up, and then we'll start selling next year. We'll all have a good time if we're at $7.80, $8, and we'll joke about, oh my gosh, remember you thought this might be a sideways move and or a counter trend rally. Haha, that'd be awesome. But I know that if we drop to $4, nobody's going to think it's funny that we thought that this was a sideways move in a new up sequence. So we've got to be hedged, because the risk is very, very real. Now, here's something else that we want to look at with soybeans. Okay, anytime we're looking at Fibonacci retracements, sometimes we always have to have a time component too, because markets tend to move in time cycles equivalent to price cycles. So 38.2% if a down move takes 10 days, then a counter trend move probably could take 3 or 6, right? Either 38.2% or 61.8% of the same time cycle. Well, in this off this down move, soybeans are right at 61.8% of their time cycle off of this down move, which means that we should be able to see whether or not beans can accelerate higher or whether they're going to die right in here. They've reached 38.2% in price and 61.8% in time. Okay. Now, what's really interesting is that our primary hedge line, which is this jagged line moving across, is going to reset all the way down to 1392, which is exactly where we're trading on Monday. If you just do the math and move forward, it's going to be at 1392 on Monday, which would be a buy signal for us in order to move higher. And it will also exceed the 61.8% time horizon. So if this is a sideways move, then if it starts to exceed the time, and it can, but generally that would mean that it's now exceeded it. So it's more of a floor now, and we might want to look higher. What will cause that? Well, I don't know. Think about it. Maybe the crop is too small. Maybe China starts buying. Maybe the market knows something about supply that we're not fully privy to yet. We don't know, but that would be a hint that this move to the downside might be done, and we may be basing. So what we're looking for is beans to make a decision here in the next few days. Now, think about this time cycle. I want to put it back in corn to help us decide whether this is a counter trend move from the downside or a consolidation after this up move. Okay, so how do we know that? Well, we're going to put the time arc right here and see where we're trading. Yeah, interesting. We've exceeded the 61.8% time retracement. If this move to the downside is our base. So if this was a counter trend move, you would have thought that we would have stopped right in here. Now, the problem with this analysis is that we also haven't really gone higher. So maybe this whole thing is a wave 2 and we're getting ready to see the explosion. But the reality is, We just don't know because it's not behaving like a wave 3, and it's certainly not really behaving like it wants to roll over and die and start a wave 3 down either. So we're either going to start one up or down. So corn is really, really difficult to trade, and I think that's what's got everything so goosey. So soybeans, I think Monday's a really big day for soybeans. Obviously, you know, I think first notice day is early next week for November, so we're going to switch out to January for next week. But I think beans are getting ready to make a more significant move. I'd love to see them come challenge this so we can put some more sales on. But the reality is, we're going to have to stay on our toes because whatever direction corn goes, I think everything else follows it. And if there's anything you're hearing me say, it's that corn really can go both directions, and we need to be prepared to adjust positions for whichever one it's going. And I try to say that with all neutrality. Okay, here's Kansas City wheat. There's lots happening in Kansas City, especially with our drought here. The world is watching what's happening. The rains that we got were nice and helpful, but certainly did not bust our drought. Australia, it's starting to dry out, so their harvest can accelerate. Argentina is a train wreck, and their crop is getting smaller by the day due to their drought. So you've got some bullish fundamentals globally, and you've got some bearish ones. And we know that Russia is sitting on a massive amount of wheat, but the question is can it get out into surplus or not? One thing that we need to be thinking about here, and this is coming, is how does the corn deficit impact Kansas City wheat in western Kansas? Because that's going to be important for our flat price, and it's also going to be important for our basis. And so one of the things that my friends are thinking about is whether or not wheat gets put into the feed ration early next spring. And if it does, right, that's like an extension to corn. It's bullish wheat, but it's also bearish corn because we just move out. So I don't know how that impacts it, but if we are feeding wheat in April and May of next year, my instinct tells me that that's extremely bullish, both corn and wheat. It's bullish corn because we don't have any, and we're either exporting it and can't pull it off the river, or it's bullish wheat because now our domestic use goes up significantly, if you enter in a wild card and the corridor shuts down in Ukraine, and all of a sudden people are buying our wheat for export, it just changes the dynamic radically and can really propel wheat higher. So wheat really looks, honestly, it looks like a turd on this chart. It looks like it's getting ready to roll over. And so I think we want to cautiously be bearish, but we want to be realistic that if corn pops higher and somebody comes in and starts buying our US wheat, then wheat's going higher as well. So we just want to be on our toes and be ready and willing to buy this market ahead of time. But we don't want to be overly bulled up on the front side because we've got to be prepared for, we've got to defend ourselves against lower prices. So in conclusion, right, it's a broken record. The factors exist to move these markets both directions, and they're compelling, and they're all unprecedented. We've never dealt with, at least in my lifetime, I have never dealt or traded through a situation with as many significantly impactful macro issues as what we're dealing with. So this is really, really difficult stuff, and we've got to let price tell us what to do and mentally be prepared to either to jump on the bearish wagon and adjust and move to the bullish side. So just stay with us because we're going to be making those calls in real time as they go. And if we're right a day and then wrong the next, you know what? We're happy with that. We're going to adjust and move on because I think that's what we've got to be, is humble enough to recognize it and jump with it. Okay, that's what I've got for you this week. Remember, there is significant risk trading futures and options, and you should only do so in light of your own financial condition. If you have questions or would like to talk through any setup that you have or any risk management issues you want to discuss, please call us. We're happy to work through them with you and create a solution that fits your risk tolerance in your farm. We will be watching, and stay in touch with us through our text messages, emails, and on our Facebook group. We'll do everything we can to communicate quickly as market developments happen. We will talk to you next week. Have a great week.